Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, I think now I'm going to finish off the lecture. I couldn't finish on Monday. On Monday lecture, we had a discussion of the multiple valuation techniques. We discussed the use and understanding of PE ratio, price to cash flow ratio, multiple forms of cash flow can be used, and the price to sales and operational ratios. And in this last bit of the lecture, we discussed a little bit the application of enterprise value multiple. We had a discussion of the process. We're going to forecast an enterprise value multiple which is appropriate for the company you're going to do the valuation, for example, Woolies. And you might come up with that estimate, highlighted in blue number here, blue color here, by using the weighted average of a group of comparable companies, or you might just take the industry average if it's relevant and appropriate. Sometimes we look at the EVM of another closest company. For example, for Woolies, obviously, the closest company will be Wesfarmers and Coles in the future. Probably in the next 12 months, we're going to have independent public listed Coles. So you might decide a premium or discount of the EVM of Woolies relative to Wesfarmers or Coles to decide this correct multiple to use in this valuation. So that number should be based on your own judgment. To come up with the enterprise value, that's the total enterprise value of the company, and we use the EBITDA, that's the operating revenue, times that multiple to get the enterprise value, and plus other assets. And this is based on the operating assets only, plus the other assets, non-operating assets, particularly you have the total enterprise value for the company. So with enterprise value multiple, we do have a view of the total value of the company, its operating assets and its non-operating assets. But when we calculate the multiple, that number, it should be based on net operating and enterprise value. That's what you see here in the brackets, highlighted in red color. So we look at the underlying performance of the operating assets only to decide that enterprise value multiple only. Then we calculate the total enterprise value. When we have that total enterprise value, we deduct non-equity claims of the company to get the net equity enterprise value attributable to shareholders, and then divided that enterprise value attributable to shareholders by number of shares outstanding to have the value per share. So the ideas of enterprise value multiple valuation is different from the PE ratio and other multiples, simple multiple like price to cash flow or price to earnings. With the price to earnings and price to cash flows, we have one single focus of the earnings estimate, which is maintainable. And we don't not really care that earnings is operating or non-operating is a combination of all operating, non-operating earnings, but we focus on the maintainable part of these earnings or income or expenses. And later on, I had a discussion of the alternative forms of the enterprise value multiples by using different earnings figures when you try to figure out the correct enterprise value multiple. So we have EBITDA, which has a focus on cash flow, because the earning before depreciation, that's the EBITDA, before depreciation has a focus on the cash flow. If you use EBITDA, that you deduct depreciation from the earnings, you actually, that number, EBITDA, which is widely used in this enterprise value multiple valuation, it's not a completely cash flow figure because you do deduct depreciation from the number, and it's not a reported earning as well. So it's somehow in the middle. So some analysts, practitioners will try to argue that we prefer using EBITDA in the enterprise value multiple because it's an earning before depreciation. We don't want to count the non-cash expense into your earnings figure. Especially for the multiple valuation, we focus on the comparison of your firm relative to a group of comparable firms. This is fine when the depreciation or capex is uniform across the group of across your group of firms, and they have similar way of managing the capital expenditure. So you may find an example from the textbook of how firms having the same level of operating earnings, they may outsource their production to other companies. They're going to have very small number of depreciation and capex. EBITDA multiple will be distorted if you apply this enterprise value multiple valuation across several firms of different production structure or different scale of depreciation and capex. Another form of the multiple can be the enterprise value over NOPLAT. So this is more appropriate when the group of firms within your comparison have different tax rate. So for example, some industries, particular firms might decide to make special investment where they may get special tax treatment from ATO. So when the tax rate is different, very much different across the comparable firms, you probably want to run the enterprise value multiple using NOPLAT. It's after tax earnings. Tax and capital structure do affect valuation for some firms. Another form will be as a candidate is EBIT. So EBIT is more, it's closer to the reported earnings, and it does include amortization and depreciation in the earnings in the multiple calculation. If depreciation is not a big concern, but here amortization may come into play, which will make a difference in your multiple valuation. What firms within the comparison group have different patterns of past mergers, acquisitions, or they may have different scale of amortization of acquired intangible assets, applying a multiple of EBIT, which does include the amortization in the earnings or multiple calculation, will distort your comparison efforts. So in this case, when you have a group of companies have different scale of merger acquisitions or different amortization practice for their acquired intangible assets, we're going to prefer enterprise value multiple over EBITDA. This is very important. You need to have an earnings in this multiple before amortization. Does amortization affect valuation? Does amortization help the company charge the value decrease of their acquired intangible assets affect their valuation? No, it does not affect their cash flow at all. It's an accounting practice. So in this case, we prefer the multiple based on EBITDA, not EBIT. So the most widely used multiple will be EBITDA, and a lot of companies, you may use EBITDA as well. It got focus on cash flow. But be very careful, have a look at the depreciation and capex of the comparable firms if you want to apply EBITDA in your analysis. And NOPLAT will be a better measure if you have a group of companies in your comparison of different tax rate. Another look of this enterprise value multiple is still a form of enterprise DCF valuation. And if you divide both, that will be the enterprise value equal to this long equation. You may find it from the textbook. If we divide both sides of the equations with EBITDA, you will get this equation. And if we take a very long-term view of the company, we might safely assume that in very long term, it's extremely difficult for any company to still create additional value by the marginal investment. So in very long term, we assume the return on invested capital equal to the weighted average cost of capital. You plug this into this equation, the equation will collapse to this one. So for most firms, the tax rate will be considered a constant. So that can be something, not a decision of the company, it's predetermined by the ITO or the corporate, the business environment. So the enterprise EBITDA enterprise value multiple is considered as the reciprocal of the weighted average cost of capital, which is in a similar form as the PE ratio. That's another view of PE ratio. So it's a reciprocal of the cost of capital. So what does it indicate for us? If we see the enterprise value multiple as this form. So the higher the weighted average cost of capital, the lower the multiple. So why there's this relation? What does higher cost of capital mean? So I guess most of you haven't listened to the recording on Monday. So higher risk of the company. Higher weighted average cost of capital here, that means there's higher risk with the company. So investors require higher expected return. So higher risk, higher cost of capital, lower ratio, multiple here. So you probably will see, when you see a group of companies, similar capital structure, but they may have different operational risk. It's going to build into the enterprise value multiple. Or companies of similar business risk, very similar portfolio composition of their assets, companies of higher debt level, or in other words, higher financial risk, the company might be trading at a discount to other comparable firms or industry average. So the enterprise value multiple does have its advantages, especially relative to PE ratio. With the PE ratio, I'll change to document camera. Hopefully it works. No, nothing happening. That's how we're going to do the PE valuation. So we do need one single estimate of maintainable earnings and one PE multiple to get the calculation, which is quite risky and only gives you a very rough idea how the company should be valued, because these are very just two parameters you input into a valuation process. It's obviously not rich enough as the enterprise DCF valuation process. But with it's still widely used by a lot of investors and analysts sometimes because of its simplicity. So for a lot of individual investors who do not really have a lot of resources, or they do not have the advanced knowledge in finance, they probably want to use the enterprise value multiple valuation instead of the PE valuation. Because for the enterprise multiple valuation, at least you have understanding of the underlying performance of the company instead of having the PE. With the PE multiple, we have the operation of the company, non-operating assets, and capital structure fall into one single thing, and we cannot disentangle one from the other. But with enterprise value multiple valuation, we do have a focus on the operating assets of the company. We do not introduce the non-operating assets into the calculation of the multiple of the EBITDA or EBITDA form. Although we do recognize that tax and capital structure might be value drivers, for some companies which have similar tax rate and similar capital structure, enterprise value multiple is a very good measure when you do comparison across firms. But there are shortcomings, obviously, when you have a group of firms of quite different tax rate or quite different history of tax credits, tax liability, and fluctuation of their tax matters. When you use the enterprise value multiple, you got to be very careful. Just make sure you compare apples to apples. There are other problems that are similar with the enterprise value multiple, similar to the problems of using PE valuation. That it's hard to build your judgment of the company's growth prospect into there. And with the PE ratio valuation, we know that there are three determinants of the PE multiple: the present value of the growth opportunities, the quality of its maintainable earnings, and also the risk, the cost of capital. So to decide the premium of a growth company relative to its peers is hard. And with the enterprise value multiple, we have a similar problem. So with this estimation, this multiple, obviously, it focuses on its existing operating assets. Any incorporation of growth outlook will be your determination of this enterprise value multiple somehow arbitrary. For instance, if you calculate the enterprise value multiple of Woolworths Coles based on their latest forecast of the next 12-month earnings as 15 times, 16 times, how are you going to decide a premium or discount to incorporate the growth opportunities? It's going to be hard with this framework. But you may consider your KGW model. It's going to be more flexible, much easier to incorporate growth opportunities into your KGW model, either from a separate spreadsheet analysis of your forecasting revenue or margin or other aspects of the company, or it might be incorporated in the forecast drivers spreadsheets. But with this method, the judgment of premium or discount will be sort of arbitrary. It's based on your own judgment. It's probably the arts part of the valuation process. So that's probably one shortcoming of this simple multiple valuation. It does have its advantages over the PE multiple valuation. And there are different forms of enterprise value multiples. You got to decide the appropriate multiple, especially the different forms of earnings to use in the multiple. In the calculation of the total enterprise value, we do use the market price, the market capitalization of the company as given the value, the correct market value of all of the shares outstanding. So that can be questionable. So to get that equity, market value of equity, we just go to stock exchange, have a look at the price, and multiply the price with total shares of the company outstanding to get the market value of equity. And we know that share price does fluctuate every second, and there are always new information coming into the market. Some information is relevant for the cash flow of the company or valuation. Some information is not relevant, so there tends to be noises around the market value of equity. So incorporate this potential of noises or distortions of the market price into the calculation of the total value of the company can be a potential risk. So basically, we do apply enterprise value multiple valuation even to all of the listed companies. That's fine, but we got to understand these limitations, and they are particularly useful when we compare the firm with other companies. And also, enterprise value multiple is widely used in private equity investment valuation. So what if we have a startup pharmaceutical company, got no sales and only expenses, R&D, no sales, nothing, and it's extremely risky to even forecast the revenue for the next 5 or 10 years, because we understand there are a few competitors developing the same drug, and it's a competition. We have no idea the success of the startup pharmaceutical company. So it's going to be extremely risky to actually fill in a KGW model, a complicated spreadsheet. So in this case, we're going to apply the enterprise value multiple, sometimes PE ratio valuation as well, to get a rough idea of the company's valuation. So enterprise value multiple is widely used in the private segment of the investment world. To identify the appropriate multiple is a tricky job, and it really relies on your judgment of the comparable firm, how relevant they are, and how much you're going to rely on these companies to come up with a correct multiple for your company, and how much weight you're going to allocate, and how much premium or discount you're going to apply for your company relative to these firms. Another relative valuation tool we probably can observe from the market that analysts use a lot, that's the PEG ratio. Is the PE ratio over the EPS growth rate. So it indicates a relative pricing, overvalued, fairly valued, or undervalued. These multiples are often used in conjunction with the enterprise DCF valuation model. They are rarely used alone to help any investment decisions or valuation. Of course, some individual investors still rely on this. More most sophisticated investors and professional investors like funds managers don't really rely solely on these simple multiples. So when you try to decide an applicable premium or discount of your company relative to the group of comparable firms, here are the principles you have to ask yourself. So if the average of the comparable firms is 15 times enterprise value multiple, what discount or premium, if any, you want to apply to your company? And you got to make the judgment based on these three perspectives. Is the company discount rate, that's the risk, higher than the average level of the comparable firms? What about the growth potential and the quality of its maintainable earnings? And these three factors will come into play together, and you got to decide the rightful premium or discount you want to apply for your company over its comparable firms. So it might be pretty much based on analyst forecast or judgment, but we do have a framework over here. So always ask yourself. I'd like to remind you of the relative weighting of these three aspects in your judgment may change. So that's the relative PE of world pharmaceuticals relative to the world index. So any ratio above 1, that means the premium. So it's not difficult to understand with pharmaceutical companies. They have a portfolio of patents, and that's which will preserve their competitive advantage within the industry. They do deserve a premium relative to the average firm in the world, in the market. But you will see they do swing, the relative PE. They do swing over the time. So over the global financial crisis, okay, we know that these pharmaceutical companies became extremely risky. It did look like this. So with the three considerations, risk, present value of growth opportunities, and the quality of its maintainable earnings, obviously risk dominated in and after the global financial crisis. That's why the premium disappeared and it became a discount. So the relative strength of the three determinants, when you decide a premium or discount, they tend to change when there's higher risk premium, or the whole world became panic about the economic outlook. Risk became the dominant force when you decide a premium or discount. So in normal economic conditions, you probably will see what happened in the past 8 years over here. So pharmaceutical companies enjoy still a very healthy, very good premium. During normal economic conditions, the quality of its maintainable earnings, the opportunity of growth potential will dominate over the risk considerations. In the second assignment, you are expected to analyze to appropriate multiple or asset-based valuation. You may choose any tool from these two groups of valuation techniques. Only use the appropriate methods. If you want to have additional analysis, you're welcome to do so if the choice of additional analysis is relevant and conducted correctly. So I would suggest you read through the assignment guidelines for the second half of the semester. For the second assignment, have some good understanding of what's expected and how you might apply this analysis. Next, we're going to have a look at an example of normalizing earnings. So I did this example in 2006 using the data of ABC, a building material company. It has building material construction service in its portfolio of operating assets. So we are looking at a company with exposure to material and construction activity as well. So in the first spreadsheet, I have a layout of how we're going to do the normalized earnings. So with the normalized earnings, probably you try to help yourself to clear your brain, clear your thoughts. Okay, we're not dealing with enterprise valuation now. We're doing normalized. Our focus is on the maintainable earnings. So maintainable earnings are income or expenses that you expect the company is going to generate or incur on a regular basis. So we don't think about operating or non-operating. We think about the consistency of that income or expense. So we'll start from the reported earnings. That's the reported profit attributable to shareholders of the company. It depends on which earnings figure you start. So you're going to have a different list of normalization items. On the right, you'll find several pages from its annual report in financial year 2015. The first section is an extract from the management analysis of its underlying profit. So it's in some way that the management tried to produce a normalized earnings to try to help the investors to understand its underlying performance. That's why it's called underlying profit. So different analysts will have different opinion of how you may normalize the profit. So this can be different, this result. For instance, for 2015, the after-tax underlying profit of $209 million can be different from the analyst figure of NPAT. So that's the management way of doing the normalization, and you got to do it in your own way. Every analyst has his or her own way of normalizing profit. So to the right, that's from the notes of the annual report of their revenue and expenses. So it's not like Woolies, they don't really give these very detailed information, but with ABC we'll see sales revenue, interest, royalties. So if we're going to enter data into the KGW model, obviously sales revenue will be more likely as operating revenue. It will go into the operating revenue in the KGW model. Interest, royalties, they are not really operating, so they will go into non-operating income. But for now, we are doing the PE valuation. We're trying to figure out the maintainable earnings of the company. So you ask yourself, is this sales revenue maintainable? Is this interest income maintainable? Is this royalty income maintainable? Do you have confidence forecasting for the future years of the sales revenue, interest, and royalty income? Okay, it looks like they're consistent revenue and cash flow that the company has been receiving in the past several years, and we do know some information of the royalties as well. So based on the nature of the item, we decide it's maintainable. It's going to go into the earnings in the PE valuation. So when we start from the profit reported earnings, try to do the normalization adjustment, the interest and royalties you see here, which are non-operating in nature but maintainable, would not be taken out of the reported earnings in the normalization process. And then you'll come to the familiar items of disposal of properties, PPE, fair value gain, acquisitions, claim settlement, rental income, and other income. So at least for the first three items, they tend to fluctuate significantly across years, and they are kind of ad hoc. Although the company does include their strategies of rationalization of its PPE, but you will see the value does change a lot. We cannot forecast a maintainable value from the net gains of disposal of PPE. So in the normalization process, we're going to get rid of this. Any gains or loss from disposal of PPE will be not maintainable. They're going to be removed from the reported earnings. Its impact, especially its after-tax impact, will be removed from the reported earnings. Other items, rental and other, we don't know other, but it's rental income. Rental income usually maintainable, because usually lease agreement will lock into a rental for several years for the entire lease period. So the rental income will not be removed from the normalization process, and you won't find rental income over here, the normalization process. And then we go to the expenses. Still, we follow the same principle. We ask, is this depreciation maintainable or not maintainable? Or amortization, is this maintainable or not maintainable? So it's amortization of intangibles. It's most likely to be internally generated intangible assets. Because for Australian companies, after 2005, amortization of goodwill, brand names are not allowed. So that amortization should be treated as depreciation. That's the value loss of the revenue generating assets that have a definite life. So these are maintainable expenses. You do expect they're going to occur in the following financial years. Impairment of PPE, okay, obviously it's arbitrary, and we don't expect next year is going to be at this level or zero. So that's going to be removed from the reported earnings in the normalization process over here, impairment of asset. You'll find notes about this, $2 million in 2014. So it's already included in disposed business units. And you will have a look at other items of the expenses. Identify the items not going to occur regularly. Okay. Let's have a look at the complete list of the normalization. So we have all of these are after-tax effects if it's taxable item. So net gain on disposal of PPE, that's the restructuring, part of the restructuring, corporate restructuring, acquisition, fair value gains. Fair value gains, it's not realized gains. It's not taxable, and we don't expect this to happen again and again in the future. Claim settlement and impairment of assets. All of these are very common normalization items you probably will see for manufacturing, industrial, and cyclical firms, and even with Woolworths. So here we have the normalized earnings. To find out the shares outstanding, you probably want to rely on the annual report for more information. They have these potential dilution effects. They often have this kind of discussion of the employee share option scheme or in long-term incentive scheme. So read information from the annual report. You might just use whatever provided by the management in the dilution effects. Then you have the diluted weighted average share, weighted number of shares, and to calculate the fully diluted normalized EPS of the company. We use that as the proxy of the maintainable earnings of the company. of course, this is based on historical data because we have things ready and it's much easier to demonstrate. Actually, you are supposed to do the normalization of your forecasted earnings as well. So plug that normalized EPS into the P multiple valuation, you're going to have an estimated valuation of the company. With the application of PE valuation, I'll give you an example of how you might run this analysis. So with the PE ratios, in the assignment folder on Watto, you are given some data like trailing PEs. These are the PE based on actual earnings, reported earnings. So obviously, the reported earnings are subject to all of these abnormal items. So they are not maintainable, and we don't use trailing PEs in valuation at all. All of the PE here are based on 12-month forward earnings forecast. And we have a group of companies. So in the building materials or construction services industry, we have these several candidates as comparable firms. So I list them all here so that you have more things, more information to compare with. So that's the ABC PE ratio, the latest forecast. That's the last number you can read from the time series that I provide on Watto. So that the latest PE ratio based on 12-month earnings forecast, and you have a historical average. That historical average is still require your judgment. How long the period you're going to include in the historical average calculation. So this analysis was done in 2016. We understand that before 2011, there was a very bumpy ride for the building material industry. So I reckon that at the time of 2016, okay, the period after early 2012 will be more relevant for me to understand the relative premium or discount of the company relative to its comparable firms for the future. So we're still forecasting the future. We're trying to apply a discount or premium on the average PE ratio of its comparable firms. I decided, okay, before 2012, there was too much uncertainty in the market. The risk premium was very high, and building materials as a cyclical industry was affected adversely. So I decided to use the average from 2012 until 2016. So you have the historical average of this PE multiple based on 12-month forward earnings. And I calculated standard deviation, one standard deviation away from the average. So these are one standard deviation, high and low, one standard deviation from the average. If we assume this, I used the 4 to 5 years average as the true mean. When I take one standard deviation, we're going to have a range of about 67%. We're going to have a range of the PE ratio. So 60% of the chance the PE of the company should be within this range. That's how I decide the high and low price of the company. And to the right, you will have this table to calculate the PE ratio. We can use the latest, the historical average, 4 to 5 years historical average, as the correct estimate for the future of the company. Or sometimes, even with that latest PE ratio of 13 times, I give you the consensus. So if it's 15 times, you still believe, okay, given your understanding of the company's business, structuring plans, of its plan of turning around Big W, of its new Australian food retailing strategies, you believe the company deserves a premium. So you might apply the premium over here. Even though its latest can be 15 times, its historical average is 15 times, you still want to apply a premium, there's no problem at all. So you might apply this premium as 15.5 or 16 times. It's totally based on your judgment. And here there are additional analysis to generate a high price, or 67% of chance how the value will be within this range, if the historical average is the true mean. With a comparable PE ratio, so ABC has exposure to both building materials and construction services. So I have World Market Index, Building Products and Construction and Engineering Services Index here. So you may calculate a relative ratio of the company to this market index and assign a weight to decide the importance of each of these index, how the companies can be priced against this index, and decide a discount of a little bit discount of 0.993. And then you multiply this discount with the Australian market PE ratio to get a relative PE ratio of ABC against Australian market. So basically, you might apply this to Australian market index relative PE and also Australian consumer staple relative PE. You may run both or choose one. So to the right, you have the calculation of relative PE valuation based on different methods of or different numbers of the relative PE ratio. Still, when you have this 12.5 times of PE ratio, you can still apply your own judgment of giving your company a discount or premium given your understanding of the company based on its quality of earnings, its risk, and present value of growth opportunities. In the next spreadsheet, we have an example of the enterprise value multiple based on EBITDA. So with ABC and its comparable firms, here I have a shorter list of comparable firms. I suppose they are more relevant for me to understand the enterprise value multiple of ABC. So they are really similar in size, obviously in the same industry, similar in size, and the depreciation and capex are quite uniform across the firms. So using EBITDA or excluding depreciation from the earnings of the multiple valuation will not distort my valuation multiple calculation. So using EBITDA for the building materials can be okay. But for some companies, EBITDA may be preferred. Some companies, EBITDA can be preferred. With this company, there's not really much difference for comparison purpose. So these are based on the forecasted earnings for 2016 when I did this analysis. I did calculate enterprise value multiple for each company. So some companies was valued at 9 times, very much premium over other companies, some companies at 3 times. And then the average of all of these comparable firms, you will see the average of all of the comparable firms is about 7.6 times. And then later I decide a weight. I suppose, okay, with CSR, it got, if you do shop at the supermarkets, you understand, CSR got much more diversified portfolio of sugar things. So it's quite kind of consumer staple. So within that 9.6 times enterprise value multiple, it got the risk reduction from some of its assets within its portfolio. So that's why it's traded at a premium. So I decided CSR is not that relevant in comparison of ABC. I only assign a 0 weight. With other company, I suppose Boral will be the closest comparable company and assign 50% weight. with that weighted average of multiple of 9.2 times. Given that, I decide ABC does not deserve a premium or discount, I'm just use that 9.2 times as the correct enterprise value multiple. For your company, you still have the freedom to apply a premium or discount based on that. To the right, we have the calculation here and a share price. With the high and low, it's up to your decision. Is 5% movement, a smaller range, or 10%